So Robinhood's actually having a great day for its stock today, and I think it's a good time to go over a more long-term view of whether or not it's a buy, hold, or sell. So as you can see, Robinhood is up 4.53% today. This is on the 20th of October, and they've been doing pretty well lately, up 240% in the past 6 months, 244% in the past year to date, up 403.52% in the past year. And over the past 5 years, we don't actually have a full 5-year span yet. They're very close, but they're not quite there because they went public around July 2021. So a few key highlights this year before we get into just raw numbers. Strong financial performance. Q1 reported a 50% year-over-year increase in total net revenues and a 114% increase in net income, beating analyst expectations. 8% year-over-year increase in funded customers, 70% increase in total platform assets. Product expansion is obviously very important here. It tells you if they are innovating or not. They have prediction markets such as NFL and college football in partnership with Kalshi, which generated investor enthusiasm as well. They seem to have a lot of momentum behind them right now. So as far as their Q3, we don't actually have their Q3 numbers yet. It's forecasted to be around 49 cents per share, and this is going to be released on November 5th. But they are projected to have 80% year-over-year growth, which is massive, and earnings per share, again, 49 cents, which would basically mark a significant increase compared to the 17-cent EPS reported in Q3 2024. As far as guidance goes, in Q2 2025, management indicated confidence for Q3, referencing strong trading across all asset classes and robust net deposits of $6 billion in July. So they're expecting, the company itself was expecting to have a really strong Q3. Analysts are expecting a really strong Q3 as well. So as far as the news goes, Robinhood looks really good. Now let's get more into the numbers. Now if you look at their last quarter, Q2, June 2025, they had really solid numbers across the board. They had year-over-year growth in revenue, net income, diluted EPS, and net profit margin by significant increases. Now some other things to point out, they do have a pretty high PE ratio, but almost every tech company has a high PE ratio these days. So I don't put a lot of stock into just that number by itself. 69.22. We're going to get into some other variations of that as well to get an idea of whether or not it's a good price, not just whether or not it's a good company. But also the dividend yield, something to keep in mind with any stock is what's your exact goal here? Are you looking to make an income and have something steady, or are you more willing to take risk and go for higher earnings, higher growth over time? Maybe you're willing to hold this longer term. So that would be an indicator to think about whether or not you're okay with the fact they don't have a dividend yield. And so this would primarily be seen as a growth stock. So if we look at their finances here, if we look at their balance sheet, their price to book is a 14.29, which, it depends on the company, but that's actually, in my opinion, not too bad, especially for what they do. Return on assets is 4.91. Now that actually could be a little bit better. Usually you want something closer to 5 to 10%, although that's very close to the low end of being what would be seen as a decent score. Anything over that range would be really good, but they're on the lower end of the range you're usually looking for. We don't actually have the return on capital on here right now. Normally you want 8 to 15%, but we don't know exactly what that is at the moment. I also like to look at assets versus liabilities. Now, if you look at the ratio here, I think the ratio is a little bit closer than I normally would like, but it's not too terrible. I mean, they do have more assets than liabilities, but normally I like to look at closer to a 2-to-1 ratio or better. But of course, that doesn't tell the whole story, and that's only one very small indicator. I also like to look at the last 3 months just as an alternate timeline here, because that's, the past year can tell one story, the past 5 years can tell another story. Past 5 years, you can really argue whether or not that's even worth looking at, because a lot can change in 10 years or less than that. But really, if you look at the past 3 months, that's a quarter of a year. So how are they doing in the last quarter? I think a month is a little bit too short of a time span, as well as a week or a day, to really gather much from that, because one big spike can really mess that up. But if you look at the past quarter and compare it to maybe the past year, the past 5 years, maybe even a 3-year time span in between there, it was good to see kind of where are they trending right now without it being too short of a time span. And it looks pretty good, up 25.7%. So if you were to project that for a year, that'd be over 100% returns. Obviously, that doesn't mean that's what's going to happen. Past results do not indicate future results, but it is an indicator among many that we like to look at. The price to earnings ratio is very close to the one we saw on Google. Of course, the one on Google is pretty much in the 60s. It's at 69.22, and if you look at this one, 65.98. Now, they use a little bit different system between the two to calculate a PE ratio. That's why I look at them separately these days, because every once in a while I'll see one stock where they're vastly different. But one is more of a forward PE ratio, the other is actually more of a trailing PE ratio. Now, another thing that's kind of an interesting thing to look at, very, very small indicator, not really worth a whole lot on its own, but hedge funds, obviously their entire goal is to manage rich people's money and get better returns than the S&P 500, or at least they try to. Now, hedge fund ownership of Robinhood has decreased by 2.79 million shares versus Q1. So that's Q2 versus Q1. And either way, the past few quarters, there's been a lot more selling than buying, especially in 2025 and in pretty much every quarter of 2024 as well. So that might be something to consider. As far as insiders go, insiders are usually people that like work at the company or something like that. And a lot of times this will tell like what they are doing with their stock. We've had 5 informative sells of 3.1 million shares of Hood in the last 3 months, but a lot of them probably just take a certain amount of profit at certain points throughout their tenure. So I wouldn't put a whole lot of stock into that, but that's just something interesting to look at. Analyst ratings here, another interesting indicator. Now, I like this one because it takes a consensus among many different types of Wall Street analysts, and you have a 73% buy score. 23% of them say to hold, 3.8% of them say to sell. Now, if you also look at their earnings over time, they've beaten on estimates every single quarter on this chart except once, and they barely missed in Q3 fiscal year 2024. But they're projected to have a really good Q3 and 2025. Another thing to look at as an alternative to something like a PE ratio, we've already looked at 2 different PE ratios. Well, this is another more raw number that's kind of a comparison that others may use. It's called an EV to EBITDA ratio, and the current ratio here for Robinhood is 71.46, which unfortunately is ranked worse than 92.23% of 528 companies in the capital markets industry that Robinhood is in. So that is a high EV to EBITDA ratio, but a lot of companies I've been looking at that have done really well have had a bad EV to EBITDA ratio. So if you look at it just by that and you don't consider the type of returns you could actually be getting and what type of company they are, then you may miss out on some good investments. So again, just one small indicator, not an end-all be-all in any way. But this can actually be an alternative to a PE ratio because PE ratios can be manipulated in certain ways through accounting and make it look like a lower PE ratio than it actually should be. And then you have something like a PEG ratio, which is a forecast 12-month forward PEG ratio for Robinhood. According to NASDAQ, is a 3.43. Now, typically you want something a little bit lower than that. So that usually is a low number in general for almost any stock that you check. Every once in a while, you'll see one that's crazy high, like reaching almost double digits. Like I like to bring up Tesla. That's the one that just kind of really stuck in my mind when they were going through a lot of problems at the beginning of the year. They had a horrible forward PEG ratio. I haven't looked at it in a few months, but that was one that really stuck out to me. And then if you look at this one, it's still a little bit high. It's not as crazy as some of the others I've seen this year, but they are still a little bit on the high end as far as the PEG ratio, which is another alternative to something like a PE ratio, because it also factors in growth over time instead of just the current price to earnings. Now, I also like to look at a company's culture. I think that's very important as to not only what is the company doing, but also you want to know if they have good leadership. And I believe a company culture is a good sign of leadership. Now, sometimes these numbers can be skewed, and it's one of those things that, again, is a small indicator that I like to look at, just because usually you want a company that has good products, that's innovating and things like that, has good numbers, but they also need to have good leadership. So 3.6 out of 5. It could be a little bit better, but it is not bad. It is not a bad score. It has actually been nominated as on the best places to work list twice in the past few years, which is a good sign as well. And you can also look at more information here about would they recommend working here to a friend. So more than half of people would recommend working here to a friend. Also, you can look at the approval rating of the CEO. So you look at 3 different scores here and kind of gather what you want to gather from it. And this has a 77% approval rating of the CEO, which I think is actually a really good score. That's over 3/4 of the employees approve of their CEO leadership. So that, I think, is a good sign that even though maybe some of these other scores could be a little bit better, that's still a pretty solid score for the CEO approval. Now, I actually have Robinhood as a buy, but I don't have them as like a strong buy. I think they're more in between strong buy and hold. I think there is potential for them to keep growing. I think they're becoming one of the, if not already, the top investment platform. They literally made investing extremely easy and easy to process, easy to get involved with their app and their website. They really made it simplified, and they have a great investment platform UI that I really love and that a lot of people love as well. But that being said, there are a few things that may indicate it's a little bit of a high price, although their growth has been amazing. They would have to continue massive growth for them to justify their PEG ratio, their PE ratio, their EV to EBITDA ratio. These things that indicate whether or not it's a good price or not. Again, it's really going to come down to whether you think yourself that you are okay with buying a growth stock that's considered to have a high ratio of pretty much every indicator that indicates whether or not it's a high or low price, and bet on the fact that you think they are going to get massive growth and continue that over time. That's really what you're asking yourself. Like I said, I believe I wouldn't put my whole investment capital budget for the month into them. If you're trying to buy one stock this month, for instance, I would maybe put like half of it or a quarter of it. Again, there are some indicators that aren't necessarily ideal, but I think it still could be a better investment than the S&P 500 and outproduce the S&P 500 over time, as it has over the past year. Another nice thing about them is they've only been public for less than 5 years. It's only been like 4 years since they've been public. So a lot of times it's good to get in early if you're going to buy a stock for the long term and you know it has a lot of growth potential. None of this, of course, is financial advice. Please make your own assumptions based on your portfolio diversity, based on how long you're willing to hold, based on what your goals are for investing in the first place. And I'll see you in the next video.